So our objective today is to construct a portfolio based on a specific investment strategy. Actively followed. Very good question. Yes, actively followed investment strategy. And then we are going to evaluate that strategy. We'll do back testing and then performance measurement and attribution. So first, what we are going to do, we will type this function EQS. So as you can see, it is equity screening, right? So there are so many companies, right? You have a question? Yeah, no. So there are so many companies. So how do we decide which company to invest in? And we talked about value strategy, right? We talked about growth strategy, right? And we also talked about somewhere in between, whole, right? Value, for example, you want to find out good companies, but which are currently underpriced in the market. Growth companies, you think they will grow at an accelerated rate, at a higher rate than the respective industry, at a higher rate than the market. So you can think about growth from different perspectives. Now, so what we are going to do, we are going to create an investment strategy, or you can say equity screening strategy. So first, I want to focus on only companies in US who have a domicile, legal incorporation in US. I will click on this. And then I'll go to North America, select United States, and then update. So you see the number of companies are decreasing, right? But it's still, we have 13,159. Now, we are interested in companies only in the S&P 500 index. So what I'm going to do, click on indices. And then I will type SPX. And update. So now we have 485, right? Okay. So our strategy will include value, momentum, and also quality. So first of all, what I'm going to do, let us go to actions, save this as, let's say, October fund. One. And update. Okay. So we saved this screen as October fund. And this should be here, right? Now, so there are many ways to construct value, right? One of the obvious ways is to look into price to book ratio, but there are many different ways, more complicated ways. We are going to go to formula. We'll actually use multiple ratios to create our value factor, the criterion. So what we are going to do, we are going to use, first of all, free cash flow yield. What is free cash flow? First of all, we are talking about cash, right? Not net income. But what does it mean when it says free?
Spend.
Yes, that is correct. That is the money the company has after it has incurred the capital expenditure, let's say. A company has to do CapEx, capital expenditure, every year, more or less, right? So, and then this free cash flow the company can use to distribute as dividends or retain within the company for further growth, right? So we are going to click on this free cash flow yield, and you will see different options. I'll choose the current one. And one more thing before we forget. So this date, let us change this date, 01/01/2021. So you can actually type here and then hit enter in this date. So we are actually going to form the strategy on January 1st, 2021. So I guess we have to type free cash flow again, free cash flow yield. Choose this current. And then append to expression 1. So it actually brings here.
Say current.
Say it again.
Current, right?
Correct. Yeah. There you go. And then if you press enter, it should be moved to the next panel, right? Okay. And do you see these numbers? Yeah, okay. Now, what we are going to do, we are going to use another ratio, which will be our revenue divided by market cap. So actually, sales per share divided by market cap per share. Okay, so first of all, I'll find out revenue from here, trailing 12 months. So trailing 12 months means immediately preceding 12 months. And then I will append to the next panel. And I want to divide this by market cap. Current. And then hit enter. Should bring this to the next panel.
Can you show the first one again? The first part of the second, the sale revenue thing? Yes.
Yeah. So let's do it again. So our revenue trailing 12 month. And then we'll divide this. I will actually write down here, divide by market cap. Correct. And then after you are here, if you click on enter on the keyboard, it should be moved to the next panel. If not, just bring your cursor at the end and then hit enter. So now these are the two criteria we are going to use to define value. But these are different metrics and they have different scale. So we are going to convert them into a normalized score, which is called Z-score. Okay, so that our strategy is not affected by differences in scale, differences in units of measurement. Okay, so what we are going to do for that, we are going to go to function, and then group cross-sectional operator. So there is a Z-score here. Do not use this one. Group cross-sectional operator. Actually, I will share this video. You can take notes. It will be long ones. I'll share this video if it helps you guys. Yeah.
Yeah, that would be very helpful. Thank you.
Yeah, no problem. Yeah, I am recording. Yeah.
Sure.
Yeah, but very good question. Yes. Yeah, that's a good thing. So we are going to go to cross-sectional and then Z-score. So cross-sectional means, for example, we are how many people? 4. This is a group. Hello. So let's say 4 companies here, right? 5 companies now, right? This is a cross-sectional group. But if I talk about only me, but over the period of time, that will be time series. Remember probably our discussion about this in our other class, quantitative investment analysis, right? So cross-sectional is multiple entities at a specific point of time. Time series is one entity over a period of time, right? So we are going to do cross-sectional, and then to construct our Z-score, the first one will be our expression 1, right? EXP. Okay. And then I will bring it to the next one. So go ahead and log into your Bloomberg, and then I will quickly help you to catch up. Okay. Yeah.
What is my saying?
So go to function, cross-sectional Z-score, and then in here type EXP1, and then 261, and then FN2 X1. Okay. Yeah, right? Okay. So you see it says it is going to calculate group G score of our expression 1, which is free cash flow. And then hit enter. If it does not bring it to the next panel, you have to bring your cursor at the end, hit enter. Sorry,
Error.
error.
Oh, it's X to X1 means X3, right? Yeah.
Yeah, so let's do this delete. Yeah, so delete this. And then go to function again. Cross-sectional Z-score. Now type EX. Okay, I see. So now
Yeah.
click on EXP2.
Oh.
Does it let you?
Mm,
It doesn't. Okay, let's try typing here EXP1. Oh, there you go. Yeah, now EXP1.
mm.
There you go. And then hit enter. Yeah, you got it. Everyone is good. Let me know once you are inside in Bloomberg. You are? Okay, yeah, just let me know. Then the next one is sales revenue, right? So this cross-sectional Z-score EXP2. Right? So now we have 2 variables in the same scale. When we calculate G-score, what do we do? we try to find out the value, how many standard deviations away, right? In how many standard deviations away. So now in our expression 5, what we are going to do, we'll just equally weight them. So 50% of our expression 3 and 50% of our expression 4. So we'll come to this formula bar box, 0.5 times our expression 3, so exp3 plus 0.5 times exp4. Hit enter. You're in. Okay, okay, just give me. Yes. Yes. Okay. Yes, as a bit of it. What was the name that we gave it? Was it Up Fund 1 or just
Yeah.
Up Fund?
Up Fund 1.
Up Fund 1. So save these. Right, in cap, all cap, OCT, and we only one. Up to the top. Now we are going to be from. Now I refresh for it. Here. Choose the date and numbers the date. IPXP1. Yeah, it just one set. Yeah, IPXP1. The end. EXP1. Here. Sometimes it doesn't move to the next panel. We just that again. And again, we'll do the first action. So it's like this. Is that a 0-1? 0-1, 0-1, very good. So we try again. So just from 0-1. Now here, I see it. I need enter. Yeah, so now that we. Okay, okay, so we have clear. This will jump a bit. Okay, so now this divide about it. Nice market cap. Now, eventually. We are seeing. Yes. Okay, that's the thing. Yeah.
Oh, yes.
Okay, so now Yeah, so now what we can do for expression 5 times this 0.5 times expression 3 is, yeah, 0.5 times USD 3 plus 0.5 USD 4. Yeah, the same.
Yeah.
Okay, thank you. Yeah, so now what we're going to do, we are going to apply another z-score on expression 5. Yes, so so make sure you choose cross-sectional z-score. I will also share the video if that helps me. Yeah, so that will save you time. Say it again.
You click on 5?
Yeah, you have to click on expression 6. So expression 6 will be z-score of expression 5. Yeah. So now exp 5. Okay. Hold on. So let me show you this one, the last one. Okay. So you have expression 6 here.
Yes.
Okay, now go to function and then cross-sectional and then choose G-score and then click on expression 6 box and then, sorry, not expression 6 box here. You type exp 5 and choose from here exp 5 and hit enter. If hit enter doesn't work, then just press on here, bring your cursor at the end, and then hit enter. Everyone is good? Okay. Now what we are going to do, we are going to save and use in EQS. And then we'll call it let's say V factor. Okay, V underscore factor. Okay, so value factor. So click on to the next box and it should let you save and use. Okay. And then it will bring you back to the EQS screen, right? Now what we are going to do, we'll hit enter. Okay. So it will be in here, value factor. Right? Okay. Let me start somewhere. Yeah, can I hit enter? So now what we are going to do is change this date to 01/01/2021. So we are observing this data as of the beginning of 2021. Now, we are going to save this Octfont 1 update, okay, so that our progress is updated. Now, our next factor is called momentum. So momentum means research shows that, and it was more true in the past than it is. If a stock experiences higher return in the previous 1 year, except for the last month of the previous year, it is more likely to go up even more. Okay. So that is how we are going to calculate our momentum factor. So we need our formula again. And we will type here total return. Okay. Huh? So formula, click on the formula and then type total return. And from this, choose 1 year. This will come here, right? Now, this is last 12 months return, right? But we want to subtract the previous 1 month return. So minus, again, type total return. Now choose 1 month. Okay. So make sure this is how your formula looks like here, right? And then at the end, bring your cursor and hit enter. So this factor is easy. This is the only variable we are going to use, but we have to convert to z-score. So function, cross-sectional, z-score. And then we are going to type exp1 this, right? Is everyone good? Your data may look different if your date is different. So we can change the date later on. That's fine. By default, Bloomberg chooses the most recent date. Okay, October 10, 2025. Now, what we are going to do, save and use, we'll call it M factor, momentum factor. Go to the next box, save and use. And then you will be here, hit enter, so that it is here. You missed which one? And one here. Minus, type minus. And type full of union. And we'll have to stop that one. Okay. And we will pass on to the and here outside to this time, yes, we will. Here. And once we will use time n underscore factor of logic n. So use here differently. So now the quality factor, which will be a little more involved, go to formula. So what we are going to do for quality, we are going to look at, let's say, ROA. What is ROA? Return on assets, right? Latest filing. Hit enter. Next, we want to, so we looked into return. We'll define quality in terms of return, and also we are going to look into volatility. of performance. Latest filing, yes. So, and then we'll type here operating margin. Latest filing. Okay. Now this is operating margin, but we want standard deviation of operating margin of each stock. So what we are going to do then, we are going to go to expression. Now we need time series. So this time series and standard deviation of each stock. This will be our expression 2. So you're good? Yeah. So from you go here, right? Under time series, choose a standard deviation, and then type EXP2, expression 2. Okay. We also want to look into, let's say, leverage, how much money the company borrowed versus how much the shareholders invested, right? Equity. So we are going to say net debt latest filing. Now divided by total capital. Latest filing. Here. Now we can create our z-scores. So we have now 3 variables. One is expression 1, another is expression 3, another is expression 4, right? So expression 3 is based on expression 2. So go to function, cross-sectional, z-score. First one is EXP1. Expression 1. Again, cross-sectional. Expression 3, not 2. Okay. And then expression 4. Now all of them are in the same units of measurement, in how many standard deviations away from the mean. Now we can weight them. We have 3, we'll just equally weight them, 33% each. So in this box, 0.33 times our expression 5 and 6 and 7. Now hit enter. and we are going to save and use. We'll call it Q quality underscore factor. And hit enter so that it is brought to the next panel. Does everyone have the same data? Yeah. Okay, very good. Now what we are going to do, we are going to create another composite score based on these three. Okay. So your group work will be much simpler. Now, I'm going to formula again. Here, I will say let us try to find out our value factor from here. V underscore factor. It is there, right? And then we'll multiply this by 0.33. And then plus our next factor was momentum. Now plus our next factor was quality. Okay, hit enter. And we have to apply z-score again. Do you guys have the same numbers here? Check your date. Yeah. Okay. And save and use in EQS. We'll call this C POSIT composite factor. Hit enter. Okay, now let's go to this watch. So basically, based on this criteria, how many stocks we have? 487. So I want to see them and the details.
What?
At the end, you will see watch at the bottom right.
Right.
Yeah. See results? Yeah, see results. Yeah. You did. Yeah, the projector is not in a very optimal position, right? I asked them, they said there is no way to change it. Anyway, so now let's look into, this is our final score, right? This is already is in descending order, right? I can check, click on it again. No, that was not a descending order. Now it is in a descending order and ascending order now. So highest so far we have 9.98, right? You have different numbers. So if you go to EQS, do you have the same date here? Okay, and then you have 487 securities.
Yes.
Okay. Yeah. The 488 securities. Go back. Back. You actually know 788. That means what you figure out. You have 488. 87. 87. I have one. Does everyone have 487? Security? Yeah. Yeah,
87.
minus no minus. Yeah, they can be details with reasonable, maybe. But let's move on. This is not a lot. This is not significantly different. And maybe you are right. It is just because this data are real time. So every terminal is syncing probably a little bit. I'm just assuming there can be hundreds of different regions. So, okay, now what I wanted to see the range of values in composite factor, right? The maximum is 9.98. And if I sort it again, minimum is 4.69, right? Negative 4.69. So, and I want to, let's say, I do not want to have more than 30 securities in my portfolio or about 30 securities. So what I can do, or actually, let's say I want any stock which has a score of above 0.5. Okay. So I'll go back to my equity screen. Now, double click on this composite factor. This composite factor. And this is what should happen, right? So you go back at the back arrow. Yes. And then double click on the. Okay, now wait here.
Yeah.
Yeah. So now go back to the equity screen and double click on the composite factor. Yeah, go back. Double click on the composite factor. Back. Now I'm just arbitrarily selecting a value. Not exactly arbitrarily, but I'm just saying I want any stock that has a value higher than 0.5. I do not want my portfolio too large. I don't want my portfolio too small. Okay. Too large, turnover, transaction cost. Too small, concentration risk. So I want greater than 0.5. So hit enter. Now I have 84, right? Okay. Now let's see what happens. And then I'm going to go to actions, save. So this is our equity screen. And we are assuming that we created this portfolio as of January 1st, 2021. Now we are going to back test it. Meaning if we had constructed this portfolio every month, going back into the last 10 years, what would have been the average performance. Let's see. So you see backtest. Click on backtest. Does everyone have this? Okay. Now what we are going to do, click on analysis period. We want last 10 years, right? I will select exact. And here I will type 01/01/2011. Hit enter. And then exact 12/31/2020. Hit enter. So choose these dates. Okay. Update. Now, analytic parameters. I'll keep things simple, equal weighted. So if there is 50 securities, I will invest 2% in each security. If there are 100 securities, 1% each security. Okay. And then I'll use the benchmark S&P 500, so SPX. Okay. And update. Our model is ready to be run. So run model. It wants us to give it a name. So we'll be consistent, oct, fund 1. Save. And you'll see this message. Your backtest is now processing. Please see EQBD for progress. You will receive a message when the backtest is finished. You will see there is a pink flashing, something pink flashing on your screen. We will just wait for that. It doesn't take long. Few seconds, maybe a minute. There we go. I have the pink message. Do you guys have it? Okay, now click on there. This is our message. Click on the attachment. Now this is the result. And I will explain a little bit. Does everyone have this? Click on that option. Yeah. Click on the link and then that option. Okay. Okay. Let's click on down the chat. Find E2 meeting. B. And then click on this plus 95 plus. Yeah. Okay. So now, so this is our portfolio screen. Our cumulative return, right? If we had invested $1 at the beginning of 2011, January 1st, 2011, we would have made $373.64. This is just the return. So you add the $1 principal. But in the index, if you just had invested in the index, you would have $358.19, right? So over this 10-year period, cumulative return from our strategy was 273, from the benchmark was 258.19, right? So we outperformed the benchmark. So this green means whenever we have our strategy outperformed the benchmark every period. In our case, our rebalancing was monthly. So these data are monthly. So almost, I don't know the percentage, but almost every month, let's say, our strategy outperformed the benchmark. Isn't that right? Okay. I'm not such a great portfolio manager. I, of course, cherry-picked some of the data points so that I can explain a few of the things to you. Otherwise, I would have been rich, okay? And I'll buy an island in somewhere and spend my rest of my life, right? Okay. So who don't want a strategy like this, right?
Mhm.
Okay. So, and these are active return. How do you measure active return? Remember, and these are monthly active return. Your return, your portfolio's return, minus your benchmark's return, active return. The difference in return between your portfolio and the benchmark, right? Okay. So first of all, this is a very strong performance. Why? Not only our strategy ended up outperforming the benchmark, it was outperforming almost every month, which shows consistency, right, of our strategy. And that's why you also see this second graph is mostly green. Now, if you look into further right, so this is a total return. These statistics are our strategies statistics. 273.64, that is our return. Now, this is our annualized from monthly return. If I have some time, I'll show you these calculations. We can download the data from Bloomberg and then we can replicate these numbers actually. Okay, if I have time, I'll show you this. This is our mean annualized return. So we calculated the average monthly return and annualized this, raises to the power 12 minus 1, right? This is our mean active return. We took the monthly active returns, calculated the average, annualized it. Mean return, maximum return, right? And then we have also standard deviation, semi-variance, tracking error. Standard deviation, everyone understands. Semi-variance, we'll probably talk about, we probably talked about this a little bit when we talked about different people view risks differently. Standard deviation measures the fluctuation from the mean, higher or lower, both. Semi-variance measures deviation only in the lower side. We are not unhappy when the return is higher than the mean. We are unhappy when the return is lower than the mean. So it is a measure of downside risk. Tracking error, you have this active return, right? You calculate the standard deviation of them and then annualize it. These numbers are annualized. And then you have Sharpe ratio, Jensen alpha, information ratio, beta, correlation. Beta is 1.05, right? Our portfolio is little riskier than the benchmark. Our correlation is strong, right? Okay. Any questions so far? No, let's go to counts. Now, this is an interesting graph. This shows you so this blue, that means the same stocks. Remember, we rebalanced every month, right? Based on our criteria, maybe the stocks that have value greater than 0.5 are different. And some stocks which were in the previous month, they don't qualify anymore. So we kick those out and bring the new ones. So if you have higher blue, like taller blue, so that basically means our strategy is very consistent. Our return is coming from the same set of stocks, which is also a positive sign. You can also see the turnover. You can download this data. Let's download this data. Let's go to overview. And then actually, let's see if we can download from here. Export. And let us save in your local drive somewhere. In your drive, not local drive. Yeah. So this is our October fund. This is turnover, and this is our benchmark, right? Now, what we are going to do, we are going to go at the end. I'll wait for you guys. You have to log in, I guess.
Yeah.
So let us just calculate the average turnover. So that means our strategy involved about, let's say, 20% turnover each month. So if our portfolio was $100 million, we bought and sold $20 million of stocks every month. Okay, any questions? Okay, now I'll go back to Bloomberg Terminal. So going back to count, I discussed this. Now let's go to security analysis. Here you can see in every month which stocks were included in the portfolio, which were out from the previous month and which are brought in new in the current month. You can go back. So on and so forth, right? Okay, so this is a good strategy. Now I'll go back if you somehow lose the link for this backtesting, you can always use this function EQBT, equity backtesting, and hit enter, and you will see all the strategies that you have backtested. So if you click on this magnifying glass, it will bring you to the same screen. Okay. Now, and these were over the last 10 years. Over the last 10 years, meaning from 2011 to 2020. We observed data in 2021, and looking back into the last 10 years relative to 2021, we see the strategy is very strong. So we want to now actually invest. And we did invest, let's say, and we want to see the performance, let's say, as of today and also at the end of 2024. For that, there is another function called PORT, Portfolio and Risk Analytics. RT, yeah. So we have used EQS, we have used EQBT, and we are going to use PORT. Hit enter. So, and this module or function is not very user-friendly, but, and we probably don't have access to a lot of different things, but still, we'll try to make the best use of it. So first of all, what you have to do in this, right, portfolio, you'll click on this search option, continue, portfolios, and find your portfolio, which is EQBT Oct Fund, right? Yeah, because these are my previously run portfolio. Yeah. I had to run several, and I have deleted, my screen was all full before I came to this strategy, right? So that I could show you how a good strategy looks like, okay? Now, select. Now, unfortunately, ideally, we want to change the benchmark, right, to SPX, but we cannot. It will not let you, so we'll be just happy with this. And then make sure you click on this. Go to apply and reload. It will probably take some time, few seconds, several seconds. There you go. Now there is a lot of information. Some of this will not make sense because I have not discussed a lot of things. First, we are going to focus on this classification. We can also download if we want by clicking on there in this Excel icon, right? But for now, we are good. So this basically shows you, I will actually zoom out a little bit so that I can see the full list. Yeah. So what you see, first of all, this is our portfolio. Under classification, this is the benchmark. Benchmark has 30. Our portfolio has 81, right? So what is the INDU? It is a Dow Jones Industrial Average Index, right? The 30 blue chip companies in the US, like an S&P 500 is 500 largest US companies. So, and these are the different sectors, right? Communication, consumer discretionary. So we see that our portfolio does not have any energy stock. Benchmark has one. We see our portfolio has one sector in utility sector, one stock in utility sector. Benchmark has none, right? And then if you go to the next part, it says percent weight, right? And you can see our portfolio has 2.53% invested in communication services. In the benchmark, it is 2.06, very similar. I should not say very similar, not extremely dramatically different. Like the next one is very different. Consumer discretionary, 19.83 and 13.11. And so on and so forth. And these are the differences. The highest difference we see in financials, right? Our portfolio, 2.53% invested in communication services. In the benchmark, it is 2.06, very similar. Not extremely dramatically different. Like the next one is very different. Consumer discretionary, 19.83 and 13.11. And so on and so forth. And these are the differences. The highest difference we see in financials, right? Our portfolio has only 15.47. Benchmark has 27%, right? Okay, so this is as of today. Now, we are going to go to aggregate. Now, what we are going to do, first of all, let's say we want to see the result. So you see the as of option here. We are going to click on here. Actually, there should be a date range option. Okay, yeah, so let's just type 12/31/24. So as of the end of 2024, and also make sure you click on this. So, first of all, these are some characteristics, right? We see under top line summary, our portfolio has slightly lower dividend yield. Higher dividend yield means it has more value than growth, right? So probably in terms of dividend yield, they're very similar. PE, our portfolio has much smaller PE. So it is more value-oriented than growth-oriented relative to the index. And we see the similar thing under price to book ratio, right? Little lower. Okay. Now, remember in the previous slide, which sector we had the highest difference? It was in financials, right? Okay. Now let's go to aggregate again. You see, these are the top bottom 5 difference market value. We had consumer discretionary higher weightage by 7.42%, right? Relative to the benchmark. But in financials, we had lower weight by 7.27%. Okay. Any questions? No? Okay. Now we are going to go to attribution. And here we have little more flexibility because remember, we constructed the portfolio at the beginning of 2021. So we are going to change these date ranges. Choose date range. And we'll choose 01/01/21 to 12/31/24. So 4 years of data, right? And then go. Now, even over the last 4 years, we are assuming actual data, right? Remember, backtest is in historical data. After we found some support, strong support in the backtest period, we actually implemented our strategy. Now we see the performance in the 4 years since our inception of the portfolio. Our strategy had 58.30%, benchmark generated 50.49%. We outperformed over the 4-year period. about 8%, so you can say 2% each year, right? Now, what drove this outperformance? We can categorize into two factors. One is asset allocation, another security allocation, another is asset allocation. So asset allocation means, remember all these different sectors? How do we allocate under different sectors? That is the first decision and probably the most important decision a portfolio manager has to make. In this case, our portfolio manager, we underperformed, right? Because of our differences in the sector weightages, our portfolio underperformed by 4.21% over the 4-year period, right? But our portfolio manager showed strong ability in picking the correct stocks in the correct sector. That drove positive 12.02%. If you add those two, that will be 7.81%. And we can also look into various details. I will stop here. Do you guys have any questions? No. Okay. So you will see a similar activity on your D2L. So go ahead and form two groups, two members each group, and solve that assignment, and then just upload on D2L. You can take a break, 5-10 minutes if you want.
Do I need to do anything?
You can probably just go. Yeah.
Oh, just log off or?
Yeah, you can just log off. Yeah.
Oh, is that it?
So you are joining via Zoom, so you don't have anything to do.
Okay. Okay.
Yeah, you'll need access to the Bloomberg terminals to do the home assignment.
Okay. And is this assignment due by the beginning of the next class, or when is it due?
Actually, I want this to be completed right now. That's why I'm giving time. So, but because you are not here, I'll give you some time. You can submit by next week.
Okay. Okay.
Yeah, work with Edward. He doesn't have a group either.
Yes.
And then I'm going to upload this video too on D2L.
Okay. Thank you.
Yeah, no problem.
And is the homework also required Bloomberg to do, or is this the homework?
There is no homework. This is the only activity you have to do
This week, right?
Yeah.
Okay. And I'm sorry, I just kind of asked a lot of questions, but
yeah, sure, no problem at all. Yeah.
So according to the schedule or whatever, it looks like we have an exam next week, or
That's true. Yes.
and are you gonna like give us like a study guide like the last time?
I will.
Okay.
Yes.
Okay. And
I'll give you a study guide, and I probably have to also extend the deadline for our project, which I could not talk about.
Okay.
So focus on the exam now and this activity, of course. Yes.
Okay. Does the
And I'll
exam
give
have
you more
to-
information, what to expect on the exam and the study guide on D2L.
Okay. And
Yeah.
does the exam including stuff that we do on the Bloomberg, or basically just the Excel from the previous class?
I'll let you know. Yeah.
Okay.
I'm still debating about it. Yeah.
Okay. All right. Gotcha. Thank you.
Yeah. Yeah. No problem. Mhm. You
Have a
too.
good night.
You too.
Bye-bye.